What's going on, guys? My name is Dory. Welcome to my channel DK Invest. In today's episode, we're going to be going over some investment strategies, the pros and cons of each one, and which strategy that works the best for me. So let's jump right into it. So the first strategy is capital preservation. Hence the name preservation. You're not looking to take on much risk. You're looking to preserve your capital. The person that would want to go into capital preservation is someone that has grown their net worth to a significant amount and they don't want to lose much of this money anymore. They either need it to fund their retirement goals, or they want to gift this money, or they have the short time period where they can invest the money, so they wouldn't want to risk too much with the market volatility. Some examples, some capital preservation would be GICs, savings accounts, checkings accounts, cashable GICs. Stuff that don't earn you a lot of interest, but they're there to not lose any of your principal. The second option would be income generation. This one is, again, someone that is not a aggressive investor. They're looking for not only to take on a little bit of risk, but they're looking to get income from their investment. So they're normally going into companies, investments, or companies that are paying a good distribution yield. So, and a good example of this would be a dividend paying company like the big banks in Canada, for example. Some of these dividend yields are 5%, 6%. So if they're investing $1 million, they're getting 6% on that, and that's funding their retirement income. They're getting a good steady flow of interest of around 50, 60K, 100K. They're getting from just interest income or their distributions from the dividends that they're getting. So that's another strategy. That is income generation. The third strategy is capital appreciation or growth. So you're really not looking so much for the income from your investments, but you're looking just to grow your capital. So if you're investing in 100 grand, you want to turn that to $1 million. That would be your capital appreciation. And with this it's going to be growth companies that will give you this. The risk is unlimited. You could buy penny stocks and have capital appreciation, or you could buy large cap value companies and have capital appreciation. It all depends on the level of risk and return you're looking to achieve. The more risk you take, the more returns that are potential for you. Some prime examples are, some high risk stuff is, cryptocurrencies, where the risk is pretty significant, or other options would be penny stocks, right? So some of these stocks are going for less than $1, right? And some of them go over $100,000 a share. So it all depends on the risk you're able to take. But sometimes with those small cap companies, some cryptos or some penny stocks, there's not much financials or data that have going on when you're investing in some of these securities. So there's a little bit more of a gamble or a risk factor happening with some of those companies. So that's the third option. So the first one was capital preservation, the second one was income generation, and the third option was capital appreciation. The fourth one would just be day trading. So this one could be you're buying and selling daily throughout the day. You're buying when the market's open. You're doing orders where it's going to sell at certain prices, and you're really looking at technical analysis when it comes to this investment style, or you're just gambling where you just believe in a company and it's not based on much fundamentals, but it's based on more on speculation and your gut feeling on certain companies. The strategies that work the best for me, it all depends on my life stage. So my personal story when it comes to investing, I initially started off investing in bank mutual funds. So I was very young. I was about 18, 19 years old. I wasn't much of a financial savvy guy, as I was still in undergrad, post-secondary school. And I just had my money in mutual funds. I was getting a solid return. I was getting about 5 to 8% on my my balanced growth mutual funds, which are not bad, but then after that, I started playing around with cannabis stocks. So back in 2018, that was the era where all these cannabis companies in Canada were blowing up, and it wasn't becoming legal yet, but it was soon to come. And so people were jumping on that bandwagon, and I made a lot of money on that, but got a little greedy with the speculation, and it wasn't based on fundamentals. Again, it was more speculation. and ended up losing a lot of the profits that I was made in some of those companies. The third strategy was something where, with earned income and a lot of savings, my net worth was growing, and I didn't want to speculate with all my money into the market. I wanted to put into sound investments. So my next strategy was putting into a lot of reputable companies like Walmart, the big banks, Facebook, Apple. I just had a diversified portfolio of many different sectors and value companies in there. And the one thing that I realized with me was my objectives were all over the place. I had some income generating stocks, I had capital appreciation generating stocks, and it was all inconsistent. So I thought to myself, what's my main objective? So I don't have enough money investing in these dividend paying companies to earn much of a distribution or income from these companies, and I didn't really want the income because I was already in a good income tax bracket. So income was not my objective when it came to investing. I realized my objective is capital appreciation. I'm a very young guy, I have a long time horizon, I could take on the risk. That's another thing to note, guys. With capital appreciation, the risk that you're taking, you need some time on your side. In the short term, that's more considered day trading short term. You need long term when it comes to capital appreciation. So that's what I had. So I thought to myself, what's the companies that give me the most growth? So then I bought all the big tech companies, Facebook, primarily the FANG companies. So Facebook, Apple, Amazon, Netflix, Google. And then slowly I started fine tuning that list of stocks where I narrowed it down. I had Apple and Facebook and Tesla. And now it's primarily, I would say 90% of my stock portfolio is in ultra growth, all in Tesla, 90%. The other 10% is divided between, Apple, Facebook, and a few other speculative companies. So that's my success story. I made a lot of money investing in, those growth companies. The best thing, the famous Warren Buffett, buy and hold. He's bought in reputable companies. He buys, Coca-Cola and some other companies where, they're not going anywhere, right? And some of the companies, if you're buying and holding and you believe in them and they're large cap companies, they have good fundamentals, it's all in. And I'll make another video, guys, on my go-to companies, and it's primarily going to be about Tesla, and I'll tell you guys why Tesla is a good long-term company and why it's not a bad idea putting all your eggs in that basket. But that'll be in another video. Anyways, guys, please like and subscribe this video, and I hope you enjoyed it. I hope to make you guys some good content with the future videos. Leave comments for any suggestions, and God bless you all, and I'll talk to you guys later.